Index fund versus mutual fund. Understanding investment vehicles. Index funds and mutual funds are popular investment vehicles that allow investors to pool their money into diversified portfolios of securities. While both aim to generate returns for investors, they differ in their investment objectives, management styles, and cost structures. 1. Definition and objectives. An index fund is a type of mutual fund or exchange-traded fund, ETF, designed to replicate the performance of a specific financial market index, such as the S&P 500 or the NASDAQ 100. The fund's objective is to match the investment returns of the index it tracks by holding a portfolio of securities similar to those in the index. 2. Investment strategy. Index funds passively manage their portfolios by holding all or a representative sample of securities in the index, without actively buying or selling based on market conditions or individual stock performance. This passive management approach aims to achieve returns comparable to the index, minus fees and expenses. 3. Management style. Index funds have low turnover rates and lower management fees compared to actively managed mutual funds because they require minimal research and portfolio adjustments. Investors benefit from broad market exposure and diversification, reducing individual stock risk and potential underperformance relative to the index. 4. Characteristics of mutual funds. Mutual funds encompass a broader category of investment funds that pool money from multiple investors to invest in diversified portfolios of stocks, bonds, or other securities. Unlike index funds, mutual funds can be actively managed by professional portfolio managers who select and adjust investments based on market trends, economic conditions, and performance expectations. 5. Investment objectives. Mutual funds may seek to outperform benchmark indices or achieve specific financial goals, such as capital appreciation, income generation, or risk mitigation. They offer varying levels of risk and return potential based on their asset allocation, investment strategy, and fund manager expertise. 6. Management fees and expenses. Mutual funds typically have higher management fees and operating expenses than index funds due to active management and research costs. These fees are deducted from fund assets and can impact overall investment returns over time, making cost efficiency an important consideration for investors. 7. Risk and return. Index funds generally exhibit lower expense ratios and turnover costs, resulting in lower fees for investors. They provide broad market exposure and consistent returns that closely mirror index performance. Mutual funds, depending on their investment strategy and management style, may offer higher return potential but also carry higher risks and fees associated with active management. 8. Investor considerations. Investors choose between index funds and mutual funds based on their investment objectives, risk tolerance, time horizon, and preference for active versus passive management. Index funds are favored for their cost-effectiveness, simplicity, and ability to track market benchmarks, while mutual funds offer active management expertise and potential for outperformance, albeit with higher costs. Conclusion. Index funds and mutual funds are distinct investment vehicles that cater to different investor preferences and financial goals. Index funds passively replicate the performance of market indices with low fees and broad diversification, appealing to investors seeking consistent returns and minimal management involvement. Mutual funds offer active management, diverse investment strategies, and potential for higher returns but come with higher costs and varying levels of risk. Understanding the differences between index funds and mutual funds helps investors make informed decisions, align investment strategies with financial objectives, and build diversified portfolios suited to their individual needs and preferences.